Welcome all to FSA Learning Module 10 on financial reporting quality. Good news, if you're getting a little bit tired, if you're doing this in chronological order and you're getting a little bit tired of FSA, the bulk of the technical material is behind you now. All we're really going to do now is kind of put it into practice and see how we look at a set of accounts, how we analyze those accounts, knowing what we do now about how they're prepared. And this is the first of those readings. So let's get into it. A lot of LOSs to get through, to be fair. There's a lot of material, but you're going to find anything technical in here, as I say, is repetitive, which is great news. So let's start with the first LOS. Compare financial reporting quality with the quality of reported results. Two different things, including quality of earnings, cash flow, and balance sheet items. So let's get to it. Definitions first of all. We have financial reporting quality, which I have shortened here to FRQ simply to fit on the screen. That's not an acronym you'll see in the module. But anyway, financial reporting quality will define, first of all, that is the quality of information in the financial reports. Meaning, can you make sense of it? High quality reporting, if the quality of information is good, if it's high quality, it will give, and this is the term used in the International Financial Reporting Standards conceptual framework, it will give you decision useful information. What does that mean? Two things, primarily two things. It is relevant and it displays faithful representation. Relevant means affects decisions. So you, as a reasonable investor, would want to know that information before you made an investment decision. And it's material. Material means it would affect your opinion, either in its nature or by its size. So decision useful information is relevant and it's also faithfully represented. That means it's complete. I always think when I'm thinking of completeness, my brain always goes towards liabilities. Is every single obligation, every single liability you need in there? It is neutral. Much more on that to come. Neutral means free from bias, so it's not biased one way or the other. We'll define those biases later as conservative versus aggressive. So it's neutral and free from error. It is correct. So if you've got unbiased, complete information that's free from error and is relevant, is what you want to know to make a decision, it is decision useful and you have high quality financial reporting that will allow you to go on and make decisions. Enhancing characteristics, being as the reading mentioned, the conceptual framework, it goes on and says, look, just so you're aware, these are the two primary criteria for decision useful information. But if you want a bit of enhancing characteristics or a couple of enhancing characteristics that are also mentioned in that framework, they present to you comparability, verifiability, timeliness, and understandability. This is obviously huge for us as analysts. It's what we're all about. Can you take one set of accounts and compare them with another set? You've seen issues around that throughout the FSA readings, IFRS versus US GAAP, for example, and wherever you have accounting choices, it gives us grief. Verifiability. Can we verify the information that's in there? Going back to the very preparation of the accounts, can management and independent auditors verify the value that's in the accounts? The example I always think about for that is PPE. Remember from the long-lived assets module, under IFRS, you have a choice of whether to put assets in at historic cost or to put them in at market value. Well, if you put them in at market value, it's more difficult to verify. You could get 4 or 5 or 6 different people to value, let's say, a property, and they'll all give you a different value. Historic cost is historic cost. So it's much easier rather to verify. But then again, what about relevance? If I said to you as an investor, what do you want to know about that building? Do you want to know what it cost them 5 years ago? Or do you want to know what it's worth today? You could argue the more relevant information is what it's worth today. So there are trade-offs here. Timeliness. Another classic trade-off. If you want to get the information out very, very quickly, you're probably going to have to sacrifice a bit of verifiability and understandability. Don't overplay this. It has to be understandable to a reasonable user of the accounts. You can't expect to give a set of accounts with exotic derivatives in there and make them so understandable that Homer Simpson could pick them up and say, oh yeah, I can see exactly what's going on here. So there is a degree of understandability. Up to there, all we've talked about is the quality of information that you're being presented with. Is it decision useful? Secondly, the quality of reported results, otherwise known as, and throughout the rest of this module really referred to as, earnings quality. They group together, and this is what they were talking about in the LOS when they put in parentheses a big list. They group together in the module the quality of earnings, so what's going on in your income statement, cash flow, obviously the cash flow statement, and your position, the balance sheet, into one term, earnings quality. So just be aware. If you get confused in the module because you say, hang on, they're talking about earnings quality here and they're asking me about the position on the balance sheet, they are grouping all of these three together. Now, what constitutes high earnings quality? Or those earnings result from activities that are sustainable and provide a sufficient ROI. Two separate things, obviously. Sustainability. Talk a little bit about this in the income statement module, the understanding the income statement module. Sustainability means, will it keep going in the future? When I analyze the income statement today and for the past 5 years and get a trend, is that trend going to keep going? Or am I looking at an income statement with a big one-off boost to earnings that isn't going to repeat? Now, a classic ratio or analysis to look at when you're trying to assess sustainability is the degree to which earnings are based on accruals accounting and how much of it turns into good, hard cash. Cash flow earnings are much more sustainable than accruals based. Accruals based tends to revert back to mean a lot quicker. And does it provide a sufficient return on investment? Obviously, we can't give you an exact figure for that. It depends on the risk of the business. The riskier the business is, the higher the return is demanded. It depends on the nature of the industry, what the ROI should be. If you're a monopoly and you're dominating, you would expect a much higher return on investment. If, on the other hand, you're in a highly competitive business, then you might be expecting in the long run to earn zero economic profit. So your accounting profit is just enough, sufficient to pay back the providers of finance their required return. But as I say, in other situations where you have a competitive advantage, maybe in a monopolistic situation, you would expect the ROI to give you more than required. The key point, why are we talking about all this? We've defined both. The key point is at the bottom here. Assessing earnings quality, making these decisions which are clearly key to whether, for example, you want to invest. You can only assess earnings quality. It's only possible with at least a basic level of financial reporting quality. If you don't have decision useful information, you cannot make a decision. You cannot decide on whether earnings are sustainable or not because you don't know. They haven't told you. Now we're going to look at a reporting spectrum momentarily, but just as a really obvious example right now, if the accounts are fraudulent, if all of the transactions are completely fabricated, you have absolutely no idea what their ROI was. So you cannot make a decision. That's what this first LOS is getting at. The second LOS will ask us to talk about or describe a spectrum for assessing financial reporting quality. It should really say, as an LOS, the spectrum, because we don't get to just invent a spectrum and talk about it, we have to talk about theirs. So that's exactly what we'll do. the assessment spectrum. Remember, just a quick reminder, we have two things to talk about here: financial reporting quality and earnings quality. Financial reporting quality ranges from high, when you have relevant information, which is complete, neutral, and free from error. Remember, that meant faithful representation. All the way down to low. The lowest quality is when it's made up. It's pure fabrication. Earnings quality goes from high. We said that was sustainable with high ROI, adequate ROI, and all the way down to low, which is unsustainable with an inadequate return on investment. So that's the way the spectrum's going to go. At the top of the spectrum, top end, the best. Number 1, we have what they call GAAP compliant. GAAP, I know we usually use it in the context of US, but in a more general sense, it means generally accepted accounting policies. So they're using it here when they just say GAAP instead of US GAAP. They're meaning generally accepted accounting policies wherever you are based. Now, clearly in our curriculum, that's going to be either US GAAP or IFRS. Decision useful. We've talked about that. So it's been prepared according to standards that are generally accepted, and it's decision useful. At that point, we have a set of financial reports in our hand that we can use to make decisions with. And when we go on and assess the high quality information we've given, we find that that information tells us earnings are sustainable and adequate. First half tells us we have high financial reporting quality. Second part here tells us we have high earnings quality. We are in business. That's the best you can get. Next step, it is still GAAP compliant. It is still decision useful. So we still have high quality financial reporting. But the numbers it shows us, we have doubts about whether earnings are either high enough, sustainable enough, or giving us an adequate ROI. So we still have high financial reporting quality, which is great news because that allows us to make a decision. But the second rung of the spectrum says that decision might be that we don't think earnings are good enough. Where do we go next? So we had the best, GAAP, decision useful and sustainable. GAAP, decision useful, so still high quality reporting, but we don't know if earnings are good enough. Number 3, still GAAP compliant, but it has biased accounting choices. And this is where we'll introduce those terms aggressive and conservative accounting. Aggressive choices are those that improve financial performance and position in the period. So right here, right now, you're boosting performance and position. That will either increase revenue, increase earnings, or your CFO, or decrease expenses or your level of debt. You decrease your level of debt, you are decreasing your leverage, which decreases the perceived level of financial risk, which improves your position. Conservative, quite simply the opposite. You can see in yellow here, you would decrease revenue, earnings, CFO, increase expenses or the level of debt. That's a conservative approach. What that tends to do, obviously, is give you a hit right now, but improve your performance position in future periods. Not always, but that is often the motivation. Let's be a little conservative now, and we can reap the rewards in the future. 2 biases. Remember what we said decision useful information was. Decision useful was neutral. If you're going either aggressive overall or conservative overall, you are no longer neutral, you are biased in one direction. Examples: earnings smoothing. You may have heard that term before. Conservative choices today, aggressive choices in the future. This is what we mean by making things look great going forward. Typically happens, certainly in this order. So conservative today, aggressive in the future, when you've done too well. Now, if you're your role at work, your job at work involves hitting targets or maybe using up budgets. You're probably all engaged in this in a very innocent way. I'm not being in any way accusatory, but we've all done it at some stage where you get to the end of the month and you're like, well, I've hit my target. I don't really want to over deliver here and set expectations for next period. So let's calm things down a little bit this period, put it away, and let's release that next period. Rather than hitting 100 this period and 40 next, let's save a bit. Let's just report 80 of that 100 this year, save 20, then I can bump that 40 up to 60 next period. And the transparency of disclosures comes in here. Does that obscure unfavorable information? That is biased reporting, because you're not letting people know the bad news and you're trying to highlight the good news. All of that goes away from being neutral. So we started off with high quality, sustainable, earnings quality, then high quality with earnings that might not be high quality. Then we biased our accounting choices. What's next in the walk of shame? So knocked out 1, 2, 3. Next, we are still compliant with GAAP, so we are not flouting the rules. But we've gone a step further than saying our accounting choices are biased here. We've gone into the world of earnings management, which is so shameful, I had to break out the red pen. What does earnings management mean? Well, here's a quote from the curriculum. Intentional choices that create biased financial reports. So, I know what you're thinking. You're probably, some of you paused the video and said, hang on, and gone back to the last page already and said, Richie, we've covered this already. We did just talk about this. There is a distinction, which I totally agree is somewhat arbitrary. They don't call it arbitrary in the underlying module. I think they say it's a fine line, a subtle difference. And what they're using is intent to make the distinction between a biased accounting choice and earnings management. It's intent. Earnings management is definitely this one. Real actions. Management sees they're not going to hit the target this period, so deliberately and with malice of forethought delays research expenditure. And, you can tell this if you have access to the information. I mean, if you don't, if they're not disclosing, different issue. But if you did have access to the information, if their accounts give you decision useful information, you'd be able to see, this is the amount of research expenditure they typically spend in this industry. It's typical for the industry, the competitors, etc. This is what they spend every month, every period. Suddenly they decide not to. And they delay it. And lo and behold, they just about hit their target this period. As opposed to accounting choices, for example, they could increase the useful economic life of their assets. If they do that, the depreciation expense per year will come down and earnings will go up. As an example, Google did that. A whole bunch of their assets extended their useful lives. Consequence was the depreciation expense fell, which will boost earnings. Why did they do that? I don't know, and I'm accusing Google of nothing. What we do not know there is intent. Obviously, if there is intent with this accounting choice, then that is earnings management. But they're just hedging their bets here and saying, look, real actions definitely are managing earnings. If it is the change in an accounting policy and accounting choice, who knows? It might be that they're out of line. That at the moment, their lives were far too short. Therefore, by lengthening them, they are getting in line with their peers, their industry. Fine. Good intentions. But we just don't know. Number 5, non-compliant accounting. You can see what we've lost here. We're no longer in line with GAAP. So what they're doing now, for example, is capitalizing research. Well, that's just wrong. You would hope the auditor would pick that up, but there you go. Incorrect treatment of transactions. Down to number 6, where we've not only gone red for the title, we've underlined in red and written stuff in red. Fictitious, obviously, it's just fraudulent. You're just making stuff up. And that's it. They asked us to describe the spectrum, and we have. One thing I would say is look how early all the way up here, how early we stopped talking about the second part of that. Earnings quality. Was it sustainable? Was it sustainable? Didn't even consider it. Sorry, there's 4 of them there, isn't there? Didn't even consider it in the 4 situations in the lower end of the spectrum, best down to worst. Why? Because once you lose that financial reporting quality, it's no longer decision useful and you cannot make a decision on earnings quality. What's next? Explain the difference between conservative and aggressive accounting. Already done it, thank you. Well, we'll have a little bit more detail on it and a few examples, but that's the beauty of this reading. Although it's long, although the module is quite long, it is quite repetitive, either because the examples you've seen in prior modules or within the reading it repeats itself. So it's good news. But here we go, conservative and aggressive. Just to set the scene, we said earlier on, again, this is repetition, unbiased financial reporting is seen as the ideal. Faithful representation, one of the characteristics of that is neutral. However, do we really want unbiased reporting? It's easy to say that, but is that fact? Investors, for example, may prefer conservative choices. You'd much rather have a positive surprise. You certainly don't want negative surprises, so you don't want aggressive accounting. But neutral, you're going to get an equal number of positive and negative surprises. So you might say, look, why don't you just be a little bit conservative about it? So I'm not going to get negative surprises. I'll probably get more positives. Management, on the other hand, may prefer aggressive choices. Obviously, the result of that is they get rewarded. So they want things to look particularly good. So although this kind of inert body floating in the sky that is the financial reporting god says, yeah, we all want neutral reporting, the people involved, the people preparing and the people using might not want it to be neutral, and more than that, have completely opposite desires. Okay, back to the financial reporting god floating in the sky who wants neutral information. Well, guess what? The standards it wrote might not actually promote neutral information. Standards, first of all, may require conservative treatment. We've seen in the PPE module how to treat research and development costs. Research expenses always expensed. Development expensed. Yes, there are exceptions if you've been through that module relating to software development costs, and in IFRS, all development costs once technological feasibility has been established, etc. But the basic rule is they're expensed. Litigation losses recognized when probable. Now, you're probably aware of a litigation process. Hopefully you've not been through one yourself, but you're probably aware how long these things can drag on. Months, years, decades sometimes. Yet as soon as the accountants decide it's probable, it's recognized, it's in there, despite the fact you might not pay this loss for another 3, 4, 5 years. And as a purely kind of, a little half, jokey-ish one, but also serious, thinking the amount of time in that income statement module that we had to spend going through the rules for revenue recognition versus how much time you spent looking at the rules for expense recognition. To get revenue in your accounts, we had that big set of 1, 2, 3, 4, 5. You have to hit all of these. And then we kind of defined what was going on with all 5 of these and blah-de-blah, how we hit them. So it's a lot more difficult to get revenue in there than it is to get an expense in there. And secondly, the standards require judgment in their application. They are not clean cut. With the best will in the world, you cannot write a standard that will tell preparers of accounts this is the exact amount that you need to put in to your accounts. A couple of examples, not nearly as exciting as they sound. Big Bath accounting conjures up all sorts of images of wild accounting parties. It's not like that at all. Big Bath accounting, typically, I say typically, really came about or the term was coined, should I say, in the heyday of massive restructuring charges. We've got a big restructuring, and it makes sense. If you do have a big one-off restructuring charge, well, let's put it to one side and say, look, that's a one-off, that's just restructuring. We'll put aside 8 million because we bought this company. It's nothing like our own brand. We're going to have to restructure it all. It's going to cost us 8 million. Just so you know, there's a big one-off cost. We're accruing for it now. Which seems, like a sensible idea. But the dark side will always abuse it if there is judgment involved. How do you know how much it's going to cost you to restructure? So you put 8 million in there and somebody nudges you on the shoulder and says, look, why don't you just put 10 million in there? Why don't you put 6? Whatever you want to try and manipulate your accounts at the time, you put in there. Why? Because then you can nibble into it whenever you need it. Big bath just means, look, it's not just for restructuring. It's a big pot of reserves. Cookie jar reserves means let's put something aside now and it's padding. We can use it in the future if we need to dip into it. So there is judgment. How do we know exactly what should go in there? And who are we to say it's wrong? Because it is a judgment call. You can't say it's correct or incorrect. We'll mention that when we talk about auditors. Now, there may be benefits to being conservative. First of all, if you're a lender, you're taking on risk. There is a situation here where you've got asymmetric information. Management has a lot more information than you do as a lender, so you are taking a risk. From that point of view, you would prefer it if that lender, or rather if that company you were lending to, was being conservative. It comes back to the same sort of idea as this. It reduces the chance of litigation. You're not going to get sued for reporting profits that are too low in most cases. It's usually because it's too high. Same for regulators and politicians. They don't want you to be overstating profits. Nobody's going to bat an eyelid if you think it was slightly too low. And in some countries, taxable income is equal to accounting income. So there's a benefit, a tangible cash benefit to being conservative. So that gets us a good start. It tells us what decision useful information looks like, how to define high quality earnings, and reasons why we might deviate away, or rather evidence that we've deviated away from decision useful information, namely biased choices, conservative, aggressive. Next up, motivation. Describe motivations that might cause management to issue financial reports that are not high quality, and conditions that are conducive to issuing low quality or even fraudulent financial reports. Let's do it. The motivations first. Motivations for mischief. It's worth just glancing through the underlying module here for two reasons. First of all, there's quite a lot of disclosures, and I've not brought them into this reading just because it doesn't add too much value, I don't think, just talking through lists of disclosures. They just say, look what happened here, look what happened here. But they're good to glance through as a review. And secondly, just look at all the words they use for manipulation of accounts. I think they use shenanigans, they use machinations, and there's one more. I can't remember what it is. Not mischief, sadly, but anyway. I've called it mischief, motivation for mischief. What motivates an otherwise all-round good human being to dabble with the lower end of the quality spectrum, to get into the dark arts in accounting? Nothing too stunning here. To mask poor performance, makes sense. Results aren't what were expected. To meet or beat analyst expectations. Now, this is often discussed in public versus private companies and your decision as an investor. Obviously, if you invest in a private company, much less disclosure, much less transparency, probably less corporate governance, less regulation. But on the other side, if you invest in a public company, they often have a short-term focus because analysts are hammering at your door every quarter. Analysts are setting expectations for your performance every quarter. And you can get into this cycle every quarter of trying to beat it rather than thinking long-term. This is the goal. Great example. It's a pretty old example, but Richard Branson, he took Virgin private. He was just sick of the share price being hammered because every quarter analysts were setting expectations they were not being met. So, fair play to Sir Richard. What he decided to do, rather than dabble in the dark arts and try and meet those expectations with low quality reports, he took the company private. Fair play. And to be fair, increased the value. Now, if you're thinking, well, that doesn't sound like Virgin at the moment, this was a long time ago. And to manipulate compensation makes sense. To try and meet your target to kick in your bonus. Now, one extra, this is just a little weird thing they add to the bottom of this motivational list. They say you would think avoiding debt covenant violations. Your lenders often put in covenants and say you cannot exceed a certain level of leverage in your accounts, or you must maintain a positive CFO. You would think that would lead people to manipulate. A study concluded that happens, but only if the company is A, highly leveraged, and B, unprofitable. So it seems like the act of a desperate company, and is not, that the quote is, it's not important overall. So these are the three reasons that are quoted. The conditions conducive to this mischief, well, they give you a fraud triangle. Opportunity, pressure on motivation, and rationalization. Not too much to say about it. Poor internal controls, good example of the opportunity to manipulate your accounts. That has happened repeatedly historically, and it's worth just mentioning Sarbanes-Oxley in the US, legislation post Enron, a huge collapse. Again, seems recent to me, but I'm old. It's way back when now, but post Enron, Sarbanes-Oxley said, look, two things. First of all, management have to take responsibility for their preparation of their accounts and the quality of their internal controls. And you'll see auditors making statements these days on the adequacy of internal controls. They will assess it. Because if controls are good enough, you should not have the opportunity. If they're not, there is the opportunity. If there is also pressure, so maybe incentives, maybe to meet your target, maybe not your personal target, maybe the board are putting pressure on you to meet targets. And the rationalization. Everyone agreed it was a good idea, so I'm doing it as well. The corporate culture. The board is nudging you, making subtle suggestions that you need to meet your target in any way you can. There's a good example given in the module of GE, trying to cover the losses of an acquisition. And the heads of all the departments saying, well, I can find 20 million from my division to cover it. I can find another 5 million. Everyone's doing it. Well, okay, that's how it works. Should not be how it works. So opportunity, motivation, and rationalization. And that's that LOS covered. Now we know that there are shenanigans, mischief. Are there mechanisms that try and implement discipline? Well, yes, there are. And the LOS says, describe mechanisms that discipline financial reporting quality and the potential limitations of those mechanisms. This is the last real kind of scene setter LOS here. It gets a bit more fun after this. So we'll get through this pretty quick and then get into the good stuff. Are there mechanisms that provide discipline? Yes, there are. So here we go. Number one, the market. The markets. Companies in the capital markets are competing for capital. Its cost, what it will cost you to raise that capital, is a function of perceived risk. If they perceive your financial reports as low quality, they are going to put a higher risk label on your business, and it's going to cost you more to raise capital. So it is in your interests to have high quality financial reports to bring down or keep down your cost of capital. If that's not incentive enough, and often it isn't, clearly that's why these things exist, then we have some other bodies. First of all, regulatory authorities, such as the SEC in the US, globally IOSCO, and so on. A few of them are listed out. Not the kind of exam that's going to ask you what does SEC or IOSCO stand for. So don't stress about it. And to be honest, look at this big list. They're not going to ask you to come up with this list either. Just be aware there are regulatory authorities. How do they impose discipline? Registration requirements before you can sell shares to the public. You have to provide a minimum level of information that they're comfortable with. Disclosure requirements, as I put here. We've seen these, a lot of them. Almost every module you've seen, whether it be long-lived assets or inventories or the income statement or deferred tax, ends with a big list of disclosures that must be in your accounts to give decision useful information. Auditing requirements, if you've been through the understanding income statements module, you've seen this already, and we're going to see it again. Here it is. Management commentary is the MD&A, as you'll see it called in the US, the management report internationally. IFRS specifies a minimum set, or rather a set of guidelines about the minimum information that should be in that management commentary. It gives you a story around where the business is going. Responsibility statements mention this. Sarbanes-Oxley internal controls. Regulatory reviews of filings. Periodically, they will pull 10Ks and go through them to make sure they are high quality. And there are enforcement mechanisms they can put in place. Fines, prosecution, public announcements. Now, this is the order it's in the underlying module. They say fines, first of all, prosecution, which sounds even worse. And then thirdly, the worst of all, a public shaming. But back to auditors. A little bit of extra info on auditors. As I say, we've seen this already, so we won't spend too long on it. But auditors are there to give an independent opinion on the accounts. They will say whether or not those accounts are fairly represented, or rather, I should say fairly presented. They'll tell you the key audit matters. Remember that? These are areas that they felt were interesting to them as auditors because they were difficult to audit. And, as mentioned with Sarbox, a statement on internal controls. Limitations of the audit. First of all, the expectation gap. Where does the expectation gap come from? It comes from users of the accounts thinking that auditors tell them that the accounts are correct. You cannot do that as an auditor. What auditors do is give you reasonable assurance that the accounts are fairly presented and free from material misstatement. That's as far as they can go. They are not checking everything. They are sampling. They're not going to pick up every single error. And are they truly independent? If you as an auditor are A, employed by, and B, paid by the company, now, before you shout at me, I know legally it's really the shareholders who are appointing the auditors. But let's be honest, how many companies do the shareholders all get together and decide which auditors they should use? It's the board that decides, presents it to the shareholders and says, do you want XYZ as your auditors? And 99% of the shareholders will be like, I've never heard of them, but yes, because this is the most dull conversation I've had in my life. And that's pretty much how it went until Arthur Andersen collapsed. And everyone got a little bit more excited about independence at that point because it had gotten crazy in terms of how much work the auditor would do for you over and above the audit, how much they were getting paid for consultancy. You started to see, after Arthur Andersen, the separation of the audit arm and the consultancy arm. So auditors have their limitations. Private contracting, loan agreements and covenants. That imposes discipline. You are raising capital. As we mentioned earlier on, the providers are likely to put covenants, put controls in place. Double-edged sword. We mentioned earlier on, we said, or rather the module said it wasn't that much of a big deal, but you're striving to make covenants for highly leveraged, unprofitable companies might be a motivation for manipulation, but it also motivates those providers of capital to monitor you. They're going to closely monitor what you're doing, which again, hopefully imposes discipline. And as promised, that's really the end of the setup. All that remains is to look at examples. The LOS we have here says, describe presentation choices, including non-GAAP measures that could be used to influence an analyst's opinion. The first thing we're looking at here on non-GAAP measures of earnings, then the next LOS is just say, okay, this is how we achieve it. But first, let's define non-GAAP measures. We have GAAP earnings, which, as the name suggests, are calculated using relevant accounting standards. Again, we're using GAAP here to mean either US GAAP or IFRS. Non-GAAP earnings, sometimes known as pro forma earnings. There are no rules. It's the Wild West. Companies say, look, I know what my GAAP earnings figure is. I've calculated a decision useful, high quality earnings figure. But here's another one that isn't GAAP based. Justification, comparability. They'll say, look, you and your financial reporting gods all want comparability. It's one of the enhancing characteristics of decision useful information. The problem is my business has these specific transactions that we always make, or these transactions that are just one-offs from last year that are making my accounts less comparable. So I'm going to adjust for those and give you a non-GAAP figure. It will be more decision useful. You'll love it, believe me. As an example, to back up that justification, EBITDA. If you've been studying any, to be honest, of corporate issuers or equity or financial statement analysis readings at CFA level 1, you'll be intimately familiar already with EBITDA. If you read the financial press at all, you'll have seen the term EBITDA. People love it. What is it? Obviously, earnings before interest and tax, the classic EBIT, operating profit. But it's also before depreciation and amortization. Why? Because they're not comparable. Different companies have different useful economic lives, different depreciation amortization policies. It's not cash. If you've seen the PPE reading, you know that. It's an accounting expense. It's not cash. So let's eliminate it. It will make company accounts or company earnings measures at least more comparable. So people from the dark side, accountants from the dark side are saying, investors do it. They don't like using your GAAP net income figure. They adjust it. We're just going to do the same to be helpful. Classic adjustments that are made to non-GAAP to pro forma earnings. First of all, rental payments for leases. If you've been through the liabilities reading, you've seen all about leases and how they're treated. Now, if you have under US GAAP, and this used to be a bigger deal, but if you have under US GAAP an operating lease, that whole payment will go through as a rental payment, as an expense. Whereas you can argue, well, this is really interest and capital, just like you would treat a finance lease. Adding back those rental payments, you get to EBITDA. You add on the R at the end to show it's before rental payments. Equity-based compensation. Not cash. That's the argument they'll use there. It's not a cash payment. I'm offering stock options. Yes, it will mean I'll eventually have to issue stock, but I'll never have to pay anything out. Acquisition-related charges. One-offs. Non-recurring. I can see the justification for that. As an analyst, what I'm probably going to be doing is taking the last 5 years' income statements, trying to get a trend and predicting. It is actually helpful. I agree. It's helpful if I can see that this year there was a big one-off charge that isn't going to repeat. Once again, in the income statement module, we said it's helpful to separate out one-offs. Impairment charges. Now, I know I'm sounding like a broken record here, but I said this up front. You're not going to see any new technical information here, really, or at least very little. You've seen impairment charges if you've been through the PPE module. It's not cash. It's not an asset you've sold at a loss. It's an asset that's still just sat there doing what it did last week. Now you happen to have just impaired it on the balance sheet. Litigation costs we talked about. That could be a long time. That looks like a W. It's meant to be an N. It could be a long time before they happen. And they're only probable, might not even happen. And gains or losses on extinguishment of debt, not cash. So you can see a common kind of theme here. One-offs and non-cash items are those that are typically excluded when a firm wants to show you non-GAAP earnings. They say, look, investors want cash measures. They're much more excited in an earnings figure that more closely resembles the cash we generate. And they want it to be indicative of the future. We want to get rid of one-offs. Another note, again, back to these loan covenants, they keep popping up, despite saying they weren't that interesting to begin with. They may use non-GAAP earnings measures. So the lender might say, this is how I want you to account for things. If that's the case, then management is likely to start focusing on those non-GAAP earnings figures. For example, if you have big leases, the lender is likely to say, I want leases treated in this way. Every single lease you have, I want to see the capital payment that you have to make. So you'll start treating them in that manner. So that's what we mean by non-GAAP earnings. But are companies allowed to present them? Or is this fraudulent reporting? Well, no, it isn't. You can put them in there. However, both the US via the SEC and internationally via IFRS have rules on how they should be presented. And to a certain extent, with the SEC, how they should be calculated. SEC, first of all, gives us definitions of what non-GAAP measures are, measures of performance that differ from that presented in the financial statements, or measures of liquidity that differs from cash flow or CFO calculated using GAAP. Oh, that's not too exciting, but thank you. What we're interested in is what they say about the presentation if they are reported. First of all, SEC. If you report a non-GAAP measure, so let's say we've reported non-GAAP earnings, some sort of EBITDA with an R in the end and missed out restructuring charges or litigation or whatever, the most directly comparable GAAP measure must be displayed with equal prominence. So right next to it, not in a smaller font, not with your non-GAAP bold and your GAAP non-bolded, not with your GAAP as a footnote after a little asterisk or anything like that. Equal prominence, you must put them side by side, and you must reconcile one to the other. This is what I've said. This is what the GAAP version would look like. There must be a justification. Why is it useful? Why are you telling me this? Management must disclose additional purposes of material for which it's used. Maybe they're using it because their lenders need it to know if you're breaching covenants. And calculation. I said it was mostly disclosure, a little bit of calculation from the SEC. Excluding charges that require cash settlement from liquidity measures is prohibited. So you can't add back if you're trying to tell your investors how liquid you are by proving what a great CFO figure you've had. You can't miss out anything that's going to be cash settled. So you can see the kind of elements typically on non-cash. Remember, we talked stock compensation, impairments, things like that. Now, you can't take anything cash out from CFO. Measures that eliminate non-recurring items cannot exclude items, and you're probably ahead of me on this, that are very likely to reoccur. That's clearly just nonsensical. You can't call it a non-recurring item if it keeps happening every single year. Not as much under IFRS, but just as logical. Definition and explanation of non-IFRS measures must be given. We said that with the SEC, a justification, a reconciliation, exactly the same, and explain why it is relevant. Now, I said I wasn't going to bring in any of the disclosures. I'm just bringing in one because I think, A, I've been talking for a long time just going through lists. There's no chunky calculations or anything to get in to break up this module. And two, because I think this is a very instructive and kind of useful one just to look at it and see how easy it is really in the cold light of day to spot nonsense. What have we got here? This is from Groupon. You've probably heard of Groupon. What they do is get you on their email list and then send you 15,409 emails an hour to see if you want to do a discounted yoga class. Doesn't seem like a great business, but there you go. What have we got here? A disclosure from their filings. Adjusted CSOI. What? So this is the non-GAAP measure that we're excited about. Adjusted CSOI, something they've made up, is operating income of our two segments. So I would say the most direct comparison would be EBIT, or income from operations, which means if they're going to present this, they have to present a reconciliation between this CSI Miami thing they've made up and actual operating income. So it's operating income, North American International, adjusted for, here we go. So they're explaining what they did, which again, they're required to do. Online marketing expense, acquisition-related costs, and stock-based compensation expense. So just stop there for a moment to try not to read on. Let's just look at those three adjustments. Here they are. You can see the reconciliation does exactly what we said it needed to do. It starts off with the most directly comparable GAAP compliant measure and adjusts us down to adjusted CSOI. And what adjustments do we have? Online marketing, stock-based compensation, and acquisition related. Okay. There you go. That's what we're excited about. This is just because they adjusted their year ends. There's nothing funky going on there. Now, of those three, let's go back to the previous page and think about what they were doing. Let's start with the bottom one, acquisition related. Big one-off. They exclude anything that is acquisition related. The logic for that has to be it's a one-off. It's not going to recur. And look, it didn't happen there. Massive there. I'd probably appreciate that as a user of the accounts to say, don't worry, this huge one-off cost isn't recurring. That's probably decision useful. Stock-based compensation. Justification for that, we said, it's a non-cash expense. Well, okay, if I'm trying to get a figure for earnings that better reflects cash flow, I can see the justification for that. And I'll live with it, and it's fairly common. Leaving us with online marketing expense. Online marketing expense is cash. And it recurs. So what are your thoughts, Groupon? Here we go. And it's kind of telling the way they presented this. They say, yeah, we do it for this, we do it for this, we do it for this. Not a dicky bird, really, about the others to begin with. They go straight into online marketing. Like, it's an admission of guilt. It's like when a sports player throws their arms up in the air after a foul to say, it wasn't me. It clearly was. So they're just flagging it immediately here. Online marketing expense primarily represents the cost to acquire new subscribers and is dictated by the amount of growth we wish to pursue. I would say what they've defined there is marketing expense. Acquisition-related costs are non-recurring, non-cash items. Okay, non-recurring, non-cash. Yeah, we said that. Stock-based compensation is non-cash. Okay. We consider adjusted CSI to be an important measure of the performance of our business, excludes expenses. Okay, so this is what they're saying CSI is. It's an important measure because, so they're justifying it. It excludes expenses that are non-cash. Okay, yes, it does. So, stock-based. Or otherwise not indicative of future operating expenses. Okay. Acquisition-related. We believe it's important to view adjusted CSOI as a complement to our entire consolidated statements of operations. Well, you still haven't justified to me this online marketing. Okay, it was big in 2010, smaller in 09 and 08, but time is going this way. It is recurring, and it's recurring with ever larger numbers. You're spending marketing expense. This is the most just a thinly related excuse to call it, justifiable I've ever seen. It's acquisition related. Marketing expenses acquiring customers. Okay. I think I've talked about it enough. The SEC, anyway, I'm not saying I've sleuthed and found this example. It was in the module because the SEC said this is absolute nonsense and forced them to restate. And when they restated, adjusted CSOI made no adjustment for marketing expenses. So just a nice little example I think that was worth pulling out just to give us a break from me reading out lists of facts. But the good news, we're at those LOSs, the last couple of LOSs I talked about, which just give us examples. Describe accounting methods, choices, estimates that could be used to manage earnings, cash flow, and balance sheet items. Great. 90% of these we have seen already, either in this module already or in the others that we've studied. So here we go. Methods of managing your earnings or your balance sheet or your cash flows. We'll start off with earnings and the balance sheet. Number one, the timing of revenue recognition when it comes in to your accounts. Remember from the income statement module, we said revenue is recognized at the point at which risks and rewards are transferred to the customer. When is that point? Well, it depends. You can define it yourself when you sign the contract with the customer. For example, imagine you have goods, you make a sale, you've got goods that leave your warehouse on the 31st of December. And you decide to recognize your revenue at the point of shipping. You'll see this term in the module, and in practice, to be fair, that's why it's there. FOB shipping, free on board shipping, means it's yours. So if this needs to get on a boat and go overseas, we've sold it to you. Once it's on the boat, if the boat sinks, your loss. It's yours. Or you could wait until it hits the destination. That's the example where it's not a sale until a customer signs, or rather makes a kind of a little stick man attempt at a signature on their little thing they hand you on your doorstep. Until they've done that, it's not a sale. So you don't recognize the revenue to that point. Well, obviously, fairly obvious example here. Last day of the year, first couple of days next year. If you decide it's the shipping point and on the 31st of December it left your warehouse, the revenue comes in this year. If instead it's at destination, the revenue will come in next year. Should be fairly clear how you can use that to manipulate your revenue. You're getting towards the end of the year. Things aren't looking great. All right, let's change our revenue recognition policy. Maybe you've always done it this way. This year, let's shift it back to the point of shipping. When you do that, you bring in revenue to this year. It's timing. It's not creating revenue. It's not fictitious. It's timing, so it's going to hurt you next year, but it's bringing profits this year. We'll worry about next year. Channel stuffing, again, related to revenue. You're getting towards the end of the year. Again, you're not going to meet your targets. What do? You offer deep discounts to try and stuff your sales channels, get product out the door. Or if you're going even further, you start to send goods that haven't even been ordered. The king of revenue recognition. Now, when I say this is an old example, it's going back to the 1980s. So we're talking 50 years ago, just about, which is crazy. But going back to the 1980s, basically Sunbeam, a corporation called Sunbeam, just invented all of this really, and would literally, in the middle of November, send out barbecues to people in Michigan. Say, look, yeah, they just don't know they want them yet. They probably will, so we'll send them anyway. Now, eventually, they're going to come back. Some of them won't, because people can't be bothered sending stuff back. But even if they do come back, you've put revenue through this year. As an analyst, be on the lookout for this. Look for days of sales outstanding. Look for extreme levels of returns after the year end. That'll give you an indication they're doing this. Bill and hold. A legitimate way of making sales. Once again, bill and hold. Goods are sold but held by the seller. We talked about this in the income statement module as well. There may be legitimate reasons. It might be that the customer has asked you to hold on to it. They don't have room. They don't have a warehouse. The problem is, if bill and hold transactions exist, they're really easy to start fabricating, I should say. You don't need much information or much effort to try and make it look like you've sold them. You just put goods in a separate corner of the warehouse and say, oh yeah, they were sold. Well, we've marked those for these customers. Risky. And the revenue arrangement. You can manage the allocation of revenue to performance obligations. Once again, back in that income statement reading. You may have 1, 2, 3, 4, 5 different elements to your performance, and you have to attach revenue to each. So for example, we talked about hardware, software maintenance, the installation of the hardware, the software provision, and the maintenance contract going forward. You could take all of that revenue and allocate it at the date you install. Not saying they will do that, but the fact that you have multiple performance obligations makes it easier to manage earnings. Rebates. If you have a history and a policy of giving rebates, you can manage the recognition of that rebate allowance. Maybe it's typically 5%. You're having a rough year, you bring it down to 4%, you bring it down to 3%. If you've read the inventories module, you know all about FIFO versus weighted average versus LIFO and the difference it makes to margins and so on. Won't cover it again because you've seen it or you're going to see it in there. You could change your cost flow assumption for inventory if you wanted to manage your earnings. And uncollectibles. If customers owe you $15 million, you're unlikely to collect all $15 million. You will have an allowance